The most dangerous mistakes in crypto aren't being made by reckless teenagers chasing meme coins. They are being made by sophisticated, middle-aged professionals in North America and Europe who think their traditional investing experience protects them. If you are applying 20th century portfolio logic to a 21st century cryptographic network, you aren't investing, you are accidentally building your own financial execution trap. It is time to dissect the quiet, unforced errors that wipe out generational wealth before the market even moves. Every single day across Reddit, Twitter, and private forums, we watch executives, engineers, and high-earning professionals in their 40s and 50s lose their shirts. They don't lose it because they lack intelligence. They lose it because they suffer from structural overconfidence, platform sprawl, and a fundamental misunderstanding of cryptographic custody rules. You're watching the Signal and Noise podcast. My name is Newell. Make sure to like and subscribe. Watch till the end for the ultimate signal. Let's look at the raw mechanics of the mid-career capital drain. Let's get straight to the root of the problem. If you've spent 20 or 30 years building a traditional portfolio in Western markets, your brain has been deeply conditioned by an implicit security blanket. You are used to a world of institutional guardrails. If you misplace a password at Vanguard, you call a helpline. If an unauthorized wire leaves your bank account, you file a dispute and the compliance department freezes the transaction. When these high-earning professionals cross the bridge into the digital asset space, they carry that exact same mental model with them. They don't realize they are walking onto a zero margin for error battlefield. They buy digital assets on centralized apps, leave huge six-figure allocations sitting on third-party exchanges, or even worse, they write their private seed keys into a Microsoft Word document saved directly to their personal cloud storage. They think they are being organized. In reality, they are handing the keys to their kingdom to every automated scraping bot on the internet. In the cryptographic domain, there is no manager to speak to, no corporate insurance policy for personal negligence, and no rollback button. The absolute finality of the blockchain turns standard administrative laziness into a total wealth wipeout. Now let's look at the second massive pitfall trending heavily across investing forums right now: operational platform sprawl. Traditional investors love the concept of diversification. They've been told for decades that spreading their capital across multiple brokerages, funds, and vehicles is the gold standard of risk management. So they apply that exact same logic to crypto. They open an account on one exchange for spot accumulation. Then they sign up for a Web3 browser wallet to explore decentralized finance. Then they buy a hardware wallet, but leave half their tokens on a secondary platform because of a promotional staking yield. Within 6 months, an otherwise organized middle-aged professional has turned their personal finance routine into a chaotic, multi-tiered software ecosystem. They are switching between 5 different apps, tracking fragmented allocations, and trying to manage varying security keys across completely disconnected networks. This doesn't reduce your risk, it multiplies your attack surface exponentially. Half the stress we see reported isn't even market-related anymore. It's pure mental clutter and tracking fatigue. When your security infrastructure becomes too complex to manage, human error is no longer a possibility. It becomes a mathematical certainty. Let's talk about tracking actual returns, because this is where the math gets incredibly distorted. A massive segment of Gen X and older millennial investors treat digital assets as a rapid way to level up their net worth so they can hit early retirement goals. They look at the dollar value of their portfolio on a green day, see a 20% spike, and think they are winning the game. But here's what they completely fail to calculate: the opportunity cost relative to the base layer. They spend dozens of hours a week swapping tokens, tracking microcap cycles, paying steep transactional slippage, and generating incredibly messy short-term capital gains tax liabilities. If they actually sat down with a spreadsheet and measured their performance against a boring passive strategy like simply holding spot Bitcoin or an index fund untouched, they would realize they are dramatically underperforming the baseline. They are burning valuable time, incurring huge tax drag, and taking on extreme structural risks just to act as manual, underpaid market makers for the ecosystem. They are fixated on the noise of short-term dollar gains while completely missing the signal of long-term asset velocity. This brings us to the psychological trap that destroys the most stable portfolios: the recovery treadmill. When a disciplined professional makes a standard investment mistake in traditional equities, say, buying a stock that drops 10%, They typically rebalance or patiently wait out the cycle. Their emotional baseline stays intact. But the sheer volatility of the digital asset market does something strange to the risk dials of older investors. The moment they experience an unforced loss, whether it's getting caught in an exchange freeze or losing capital to an early-stage project that tanks, their fight-or-flight response takes over. Because they feel they have a shorter time horizon until retirement compared to a 20-year-old, they panic. They don't want to accept the loss and wait years to compound it back naturally. So what do? They attempt to speedrun their recovery. They discover high-leverage futures trading. They pull capital from their stable retirement accounts, max out lines of credit, and throw massive size into highly speculative tokens, hoping for a 10 times recovery overnight. They convince themselves they are using a sophisticated trading strategy, but in reality, they've completely abandoned investing and crossed over into pure emotional gambling. The desire to instantly break even overrides decades of established financial discipline. Let's analyze the final mechanism keeping these investors trapped: ideological anchoring. When an experienced investor buys into this space, they usually enter through one of two extremes. They either fall into the black box law mindset, treating the entire asset class as an entry-exit casino ticket with no underlying structural utility, or they go down the rabbit hole so deeply that they become completely captured by community ideology. They start letting tribal internet politics dictate their allocation decisions. They buy an asset because an online group told them it's a hedge against a specific economic collapse, or they refuse to sell a declining asset because they are emotionally anchored to the exact price they paid for it. The market does not know what you paid for your assets, and it does not care about your political preferences. Good investing is fundamentally about avoiding unforced errors and keeping your infrastructure dead simple. The fancier your setup gets and the more emotional your attachment becomes, the easier it is for structural risk to hide inside your portfolio. If you want to survive this space long-term, as a high-earning professional, you have to ruthlessly simplify your operational environment. Number 1. Kill the sprawl. Consolidate your asset holdings onto the absolute minimum number of secure platforms necessary. If your digital wealth requires maintaining a small software ecosystem just to view your balance sheet, you are doing it wrong. Number 2. Automate your contributions. Isolate your core long-term allocations into cold storage custody that you do not touch, and completely tune out the daily media fire hose. You do not need a complex, hyperactive strategy to win the wealth velocity game. You win by keeping your operational overhead near zero, minimizing your tax drag, and letting absolute scarcity do the heavy lifting over a multi-year horizon. Stop trying to outtrade a market run by algorithms, and stop treating a cryptographic network like a 1990s retail bank account. This is, however, not financial advice. Please endeavor to do your own research. If you found value in this breakdown, hit that subscribe button, smash the like, and drop a comment below. Have you caught yourself overcomplicating your setup across too many apps, or are you keeping your blueprint clean? Let's talk about it. Until next time, keep it mechanical, look for the signal, and ignore the noise.